Hi there, welcome back to my channel. In today's video, I'm going to be showing you the best places to invest your money. When it comes to investing your money, it can be difficult to decide where to put it. There are a variety of options available, and each has its own pros and cons. In this video, we'll explore the best places to invest your money, discussing the advantages and disadvantages of each option. From stocks and bonds to real estate and mutual funds, we'll discuss the different strategies you can use to make your money work for you. But before we dive into the details, I just wanted to say a quick thank you to all of you who have been supporting my channel. It means the world to me to see your comments and messages, and I'm so grateful for your encouragement. Now getting back to the topic at hand. What are the best places to invest your money? 1. Stocks. Stocks are an investment in the ownership of a company. When you buy a stock, you are buying a share of ownership in that company. Stocks have historically provided the highest returns over the long term, although they are also the most volatile. The value of a stock can be affected by many factors, including the company's financial performance, economic conditions, and investor sentiment. Investing in individual stocks can be risky, but it can also be very rewarding if done correctly. One way to reduce risk is to invest in a diversified portfolio of stocks through mutual funds or exchange-traded funds, ETFs. This spreads your investment across many companies and can help mitigate the risk of any one company underperforming. Investing in stocks requires research and analysis of the companies you are considering investing in. It is important to understand their financials, competitive advantages, and growth prospects before making an investment. It is also recommended to consult with a financial advisor to help you make informed decisions and create a well-diversified portfolio. 2. Bonds. Bonds are a type of investment in which an investor loans money to a company or government in exchange for regular interest payments and the return of the principal amount at the end of the bond term. Bonds are generally considered less risky than stocks and can provide a steady stream of income. The value of a bond is affected by changes in interest rates, with bond prices generally falling when interest rates rise and rising when interest rates fall. This means that bonds can provide a hedge against stock market volatility, as they tend to perform well when stocks perform poorly. Investing in bonds can be done through individual bonds, bond mutual funds, or bond exchange-traded funds, ETFs. Diversification is important when investing in bonds, just as it is when investing in stocks. Investors should consider investing in a diversified portfolio of bonds, including both government and corporate bonds, to help reduce risk. It is important to carefully consider the creditworthiness of the issuer of the bond before investing, as well as the bond's duration, yield, and other factors that can affect its value. Consulting with a financial advisor can help ensure that you are making informed investment decisions. 3. Real estate. Real estate is a tangible asset that can provide both rental income and capital appreciation over the long term. Investing in real estate can be done through purchasing rental properties, real estate investment trusts, REITs, or real estate mutual funds. Purchasing rental properties can provide a source of passive income through rent payments, as well as potential capital appreciation over time. However, it is important to carefully consider the costs associated with owning and maintaining a rental property, such as property taxes, repairs, and vacancies. Investing in REITs or real estate mutual funds can provide exposure to a diversified portfolio of properties without the responsibilities of property ownership. These investments can provide regular dividend payments and potential capital appreciation over time. Real estate investments can be affected by a variety of factors, such as changes in interest rates, economic conditions, and demographic trends. It is important to carefully research and analyze potential investments, as well as consult with a financial advisor to help create a well-diversified portfolio. 4. Cryptocurrencies. Cryptocurrencies are digital assets that use cryptography to secure and verify transactions and to control the creation of new units. Bitcoin, Ethereum, and Ripple are some of the most well-known cryptocurrencies. Cryptocurrencies have gained popularity in recent years due to their potential for high returns, but they are also highly speculative and can be volatile. The value of cryptocurrencies can be affected by factors such as regulatory changes, adoption rates, and investor sentiment. Investing in cryptocurrencies requires an understanding of the technology behind them, as well as the risks involved. Cryptocurrencies can be purchased through cryptocurrency exchanges or peer-to-peer platforms. It is important to carefully consider the risks before investing in cryptocurrencies. Some experts recommend limiting cryptocurrency investments to a small portion of your overall portfolio, as they can be subject to extreme price swings and lack the stability of more traditional investments such as stocks and bonds. As with any investment, it is recommended to consult with a financial advisor before making any investment decisions. 5. Exchange-traded funds, ETFs. Exchange-traded funds, ETFs, are investment funds that trade on stock exchanges, allowing investors to buy and sell them like individual stocks. ETFs hold a diversified portfolio of stocks, bonds, or other assets, and can provide investors with exposure to a variety of markets and sectors. ETFs offer several advantages, including low fees, easy diversification, and flexibility. They can be bought and sold throughout the trading day, unlike mutual funds which are priced and traded only once per day. This means that ETFs can provide investors with greater control over their investments and the ability to react quickly to market changes. Investing in ETFs requires research and analysis of the fund's holdings and performance, as well as an understanding of the market or sector the ETF is designed to track. It is important to create a well-diversified portfolio of ETFs to help mitigate risk and maximize returns. Consulting with a financial advisor can help ensure that you are making informed investment decisions and creating a portfolio that aligns with your financial goals and risk tolerance. 6. Index funds. Index funds are a type of mutual fund or exchange-traded fund, ETF, that tracks the performance of a specific market index, such as the S&P 500 or the NASDAQ. Index funds aim to replicate the performance of the index they track, providing investors with exposure to a diversified portfolio of stocks or other assets. Index funds are popular among investors due to their low fees, tax efficiency, and simplicity. Because they aim to track an index rather than actively manage investments, they have lower management fees and can provide higher returns over time. Investing in index funds requires research and analysis of the index being tracked, as well as an understanding of the market or sector the index represents. It is important to create a well-diversified portfolio of index funds to help mitigate risk and maximize returns. Consulting with a financial advisor can help ensure that you are making informed investment decisions and creating a portfolio that aligns with your financial goals and risk tolerance. 7. Mutual funds. Mutual funds are a type of investment fund that pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other assets. Mutual funds are managed by professional fund managers who make investment decisions based on the fund's investment objective and strategy. Mutual funds offer several advantages, including diversification, professional management, and liquidity. They can provide exposure to a variety of markets and sectors, and can be bought and sold on any trading day at the current net asset value (NAV). Investing in mutual funds requires research and analysis of the fund's investment strategy, fees, and historical performance. It is important to create a well-diversified portfolio of mutual funds to help mitigate risk and maximize returns. Consulting with a financial advisor can help ensure that you are making informed investment decisions and creating a portfolio that aligns with your financial goals and risk tolerance. Mutual funds may have higher fees compared to other investment options like ETFs, but can provide benefits such as active management and access to alternative assets. 8. Certificate of Deposits, CDs. Certificates of Deposit, CDs, are a type of savings account offered by banks and credit unions that provide a fixed rate of interest for a specific term, ranging from a few months to several years. CDs are a low-risk investment option that can provide a guaranteed return on investment. CDs offer several advantages, including safety, liquidity, and predictable returns. They are insured by the Federal Deposit Insurance Corporation or the National Credit Union Administration, providing protection against bank or credit union failures. Investing in CDs requires consideration of the length of the term and the interest rate offered, as well as the penalties for early withdrawal. CD interest rates may be lower than other investment options, but can provide a stable return for investors looking for a low-risk option. CDs can be a useful part of a well-diversified investment portfolio, providing a safe and predictable investment option for short to medium-term goals. Consulting with a financial advisor can help ensure that you are making informed investment decisions and creating a portfolio that aligns with your financial goals and risk tolerance. 9. Robo-advisors. Robo-advisors are online investment platforms that use algorithms to provide automated investment advice and management services. They offer investors a low-cost and convenient way to invest in a diversified portfolio of stocks, bonds, or other assets based on their financial goals and risk tolerance. Robo-advisors use advanced algorithms and sophisticated software to make investment decisions based on market trends, historical performance, and risk analysis. They can provide personalized investment recommendations and management services, including portfolio rebalancing and tax loss harvesting. Investing with robo-advisors requires opening an account and answering a series of questions to determine your investment goals and risk tolerance. Robo-advisors charge lower fees than traditional investment advisors, making them an attractive option for cost-conscious investors. Robo-advisors can be a useful part of a well-diversified investment portfolio, providing a convenient and low-cost way to invest in the market. However, it is important to research and compare different robo-advisors to find the one that best suits your needs and financial goals. 10. Peer-to-peer lending. Peer-to-peer lending, P2P lending, is a type of lending that connects borrowers with individual investors through online platforms. P2P lending allows borrowers to obtain loans at lower interest rates than traditional lenders, while investors can earn higher returns on their investments than other fixed-income investments. P2P lending platforms use algorithms and credit scoring systems to match borrowers with investors based on their creditworthiness and investment criteria. P2P lending offers several advantages, including lower fees, faster processing, and access to loans for borrowers who may not qualify for traditional loans. Investing in P2P lending requires selecting a reputable platform, conducting due diligence on borrowers and their creditworthiness, and diversifying investments across multiple loans. P2P lending also carries the risk of default or late payments, so it is important to carefully consider the risks and rewards of P2P lending before investing. P2P lending can be a useful part of a well-diversified investment portfolio, providing investors with access to fixed-income investments and borrowers with access to lower-cost loans. However, it is important to carefully evaluate the risks and returns of P2P lending before investing. In conclusion, there are many places to invest your money, including stocks, bonds, real estate, cryptocurrencies, retirement accounts, and mutual funds/ETFs. Each option has its own advantages and disadvantages, and the best choice depends on your individual financial situation and goals. It's important to do your research, seek the advice of a financial professional, and make informed decisions before investing your money. Remember, investing involves risk, so it's important to have a long-term investment plan and to diversify your portfolio to minimize risk. Thanks for watching this video. If you enjoyed it, don't forget to give it a thumbs up and hit that subscribe button for more content like this. And if you have any questions or suggestions, please leave them in the comments below. And as always, we appreciate your support, and we'll see you in the next video.